CF Benchmarks.
What you're about to hear is a recording of a CF Benchmarks X Space captured live.
All right. I think it's time to get the show rolling here. So, welcome back, everyone, to another CFB Talks Digital Assets Live. My name is Gabe Selby. I'm the head of research at CF Benchmarks. With me, as always, we've got the usual crew: Mark Pilipczuk, a research analyst at CF Benchmarks; Tomas Perfumo, the chief economist at Kraken; and joining us this week, David Lawant, dear friend, head of research at Anchorage Digital, and our very own head of business development, Peter Stern. I want to kick things off with a brief introduction from the both of you. But before we get into that, I'm going to run through our quick compliance note. Everything on this show is for informational and educational purposes only. It's not investment advice, and nothing we discuss is a recommendation to buy, sell, or hold any asset. The views are our own and do not represent CF Benchmarks, Kraken, or any affiliated firm. Any price targets, valuations, or models we mention are illustrative and not forecasts. The participants and their firms may hold positions in the assets discussed. Digital assets are volatile, and you can lose your entire investment. And some products we reference may not be available in your region. Always do your own research and consult a qualified financial advisor before making any decision. I think, David, why don't we start with you? You're a guest, I think, that does not need an introduction, but if you would like to just give us a quick background on yourself and what you've been up to.
Yeah, of course. Thank you, folks. Thanks for having me here. I'm excited for the chat. So I'm David Lawant. I'm head of research at Anchorage Digital. Anchorage, for those who don't know, is one of the leading crypto infrastructure companies for institutional investors. We do a lot of things from custody all the way to trading, derivatives, prime financing. We're also known for being the first crypto company to get an OCC banking charter, meaning we're very active on things like stablecoin issuance now that the Genius Act is underway and being implemented. We also have, we provide banking services and things like that. I'm relatively new to Anchorage. I've been with the firm for about 6 months or so. Before that, I was at FalconX, which is one of the larger trading desks in the space. Before that, I had the pleasure of working with Peter at Bitwise Asset Management. And before that, I used to work in TradFi. So that's, in a nutshell, my background. Excited for the chat.
Yeah, that's why I thought, it'd be great to get the colleagues back together. Peter, if you don't mind giving us a quick intro on your side.
Yeah, no, thanks, Gabe. And I head up business development for CF Benchmarks. Based in the States, based in Chicago, and primarily work along with a colleague of mine, Alex, on client relationships in North America and in Central and South America as well. Been here for almost 6 years, and then as David said, had the pleasure of working with him at Bitwise prior for 2 years. And then I also come from TradFi, so I crossed over with you at Deutsche Bank. So glad to obviously be on here. Thanks a lot, Gabe.
Oh, thank you. And it looks like our very own CEO is also going to be joining us today. So, Sui, we'll get you upgraded here to also participate in this discussion. The run of the show is going to be pretty action-packed. We've got a lot going on. I think it makes sense to start off with what the Fed did yesterday in Kevin Warsh's first meeting. Then we're going to dive into some research that David recently put out on synthetic yield and Bitcoin. And we're also going to talk about some of the key developments that we're seeing in the industry. Peter's going to share some of those key discussions that he's having with his partners and the folks that he discusses with on the reg. And we'll finish it off with a fast round like we normally do. So to kick things off, I think it makes sense to jump over to the FOMC rate decision. They held unanimously the rate at the 3.5, 3.75, and keeping the range the same. This was not really a surprise. I think what was a surprise is really kind of like what we saw with the releases of the statement, which was dramatically cut down from 341 words to about 130 words. There's definitely a lot of, I think, anticipation for more changes to come. There's a lot of task force being announced. And we also saw a dot that was missing on the dot plot, right? So every quarter meeting, you get revised dots. And there was a lot of speculation going into this meeting that there would be a missing dot, and sure enough, we can probably speculate that Kevin Warsh was the one that did not submit a dot. So I think it'd be great to kind of kick things off with a round robin question. Let's go around and give a quick grade A through F on rating our new Fed chair, Kevin Warsh, in his first performance, in his first inaugural debut. And I think we'll give the first go around to our guest of honor, David. I think maybe you could also share a little bit about how you might know Kevin Warsh, or you might have studied alongside him, maybe at Stanford. So yeah.
Ooh, yeah, okay. Well, I have to give Kevin an A. I'm a big fan of him. I had the pleasure of having him as a professor lecturer during my grad school years. But honestly, I think he did what he was supposed to do. The most important thing I believe he established is the central bank independence, right? I think a lot of folks were coming into this meeting with the perception that he would just do whatever Trump's want to do, that he would aggressively sign toward lower interest rates or cutting interest rates at some point in the future, which is very different from where the market expectations are. And I think he came up with a much more, I would say, a neutral stance. I mean, to your point, he didn't provide his estimates for the dot plots and for the SEP, the summary of economic projections in general. And then the other thing I would say is that I find salubrious his stance on Fed communication. This idea that, especially I think he had a line during the press conference saying that he thinks that the markets are more efficient when the markets are reacting to the data, more so than when the markets are reacting to what they think the Fed will think about the data, you know?
And we're going to have to go into that one. I definitely want to be going into that one, but yes, continue. Sorry.
Yeah. And so that's what I would say. I mean, yeah, I'm a big fan of Kevin Warsh, and I think he did a great job. Of course, no one's perfect in hindsight, and just watching here from the sidelines, there's probably a bunch of things that anyone could have say, hey, he could have done better here or there. But I think overall he did a good job. And I think the most important one was to kind of reestablish this kind of perception of Federal Reserve independence that I think has been a topic of discussion for a good, 6 to 9 months now.
I'm sorry, I was on mute. I'm going to go in the order of the people on my screen here. So I think, Mark, you're next to David. So why don't you take the next shot?
All right, yeah. For me, I'm going to give him a B. There were some things that I really liked. I liked that they were establishing, he talked extensively about establishing task force, really looking at the data, and I actually liked his stance on inflation, coming out as a bit of an inflation hawk here, trying to get that back down. What I was not a fan of is that trying to get away from the Fed giving guidance on rates. I think that's a pretty important tool in the Fed's toolbox that they should be using to kind of work with the market there, work in tandem with it a little bit. So yeah, for me it's a B. I do like the way that they're being very data dependent and data driven. I just didn't like the removal of guidance.
Yeah, fair enough. I do want to go into discuss that a little bit further with our guests here. Tomas, you're next.
I'm also gonna give him like an A as well. If you wanted to do like point system, I wouldn't say it was 100, but I would say it was above 95. And I think for me personally, what I really wanted to see was some level of certainty around what his process is going to look like on handling the gap between what he tells people around changes he wants to make, like forward guidance, changes to the SEP and stuff like that, and when we should expect those next steps to take place. And so he kind of articulated that with the task forces and put a bit of a time box around it in the fall into the end of the year, where they would be discussing finalization of proposals. So that was good. I think he also did a really great job with the communication. It was very straightforward. It was very succinct. It was very direct. So in the context of, hey, this person's coming in and it seems like he's going to introduce a higher degree of uncertainty, I came away feeling like he really had a confidence around his articulation around what next steps would look like, and so I was very pleased with that. I think the only thing that I would knock off points for were some of the kind of casually flippant comments around, this is why we have a task force, where it's not totally clear what the remit of those task force is, but he did mention that it's, day or week 3, and so I'll give him a pass on that. I think next meeting is going to be even more important in that regard.
Peter, you're next to Tomas here, so you get the honors.
Thank you. Yeah, I would give him probably an A to an A minus around that grade. I thought he did a very good job. To echo Tomas, I thought he was very articulate, calm. He was very direct. I would say speaking to institutions as well as just general financial professionals, kind of across the board, both in work and personal life, like inflation has been such an issue. So I think him being very hawkish on that and being outspoken about that is, I found that very impressive and something that I think is overly, very important in the markets today. I mean, regardless of what city you live in, that's always a topic. I know, Gabe, you and I speak about inflation a lot. So I would definitely give him an A grade.
I find myself speaking about inflation too much. It's almost like become my personality. I'm like,
Yep.
Show up to the parties or like the gatherings, just saying, I just went to an Angels game and spent $150.
Oh yeah.
So it's just getting out of
Yeah,
control.
as you and I both having younger daughters, I would say that the cost of clothes and other air quotes necessities that the little ones need, have definitely gone up in the past couple of years. So I see myself speaking about it on a hourly basis almost.
Good. Yeah. Sui, I think you might have access to speak now. So do you want to test that and then perhaps give us a grade? And it looks like it still might be Sui,
Great
are you
to
with
be
us?
here, guys. Great to be here, guys. Thank you very much for having me join. Always great to hear what the much more elevated minds on the CFB X space have to think about some of the major financial issues of today. Looking at it from the UK, from London here, over in London, I was pretty impressed with Warsh. I think for those of us who are a bit older, over the years, the amount of energy, time and energy spent parsing statements coming from FOMC meetings, etc., and trying to pick through the words of Fed governors and the Fed chair, obviously, just takes up ever more time. So very happy that Warsh has cut down significantly the amount of words that come out of the Fed. His statement was, I think it was 120 words. From the last one from Powell was 300 words. So yeah, definite thumbs up. I think for clear communication, very clear, very succinct, and very interesting that. There was obviously the Fed has a dual mandate, and so he has to talk about both sides. But the final word went to price stability, the commitment to maintaining price stability. So I think it's very clear which side of the mandate that Warsh, at least right now, thinks is the most important. And I think that's much more valuable than a dot plot. I think that I'm pretty agnostic to the dot plot, but I think that this is his communication style is giving the markets a lot better view of where their view is, which is what matters, and for the market to be as data driven as the Fed.
Yes, and those are all great points. I want to kind of double click on the dot plot. I'll wrap things up with my grade. I think I'm going to go with a C minus. I'm grading him a bit on a curve. Look, it's his first meeting. We've seen how first meetings can go historically with Fed chairs, new Fed chairs. They tend to have some bumpy starts. There's some great things that I'm excited for. I think that we absolutely need to be always revisiting frameworks, always be challenging things and questioning. What's the best way forward for monetary policy. I do like the fact that he is someone who's a proponent for crypto and blockchain technology and wants to see the industry succeed and do well here in the home turf of the United States. Where I think he fell short was I think on the communication around the dot plots and the markets and trying to understand what really drives that. And it was almost like I was listening to Bloomberg Radio as I normally do when these things happen. I felt like I was just taking a bit of crazy pills, and I just want to try and understand a little bit more of how he thinks he's going to change some of these this market and Fed reaction function. Look, I think everyone on this call would agree that the dot plots aren't perfect, and he pointed out that they very rarely materialize to come to fruition. And I think it's important to ask why. Why is that the dot plots rarely materialize to what actually happens in real life? Why is it that the OIS futures curve rarely materializes to what happens actually in real life? And I think you ask why again. It's because the things change. Data comes out, economic surprises happen, and the markets react accordingly, and the Fed reacts accordingly. So I just found it to be kind of a bit. I'm trying to understand. I guess I find it a bit contradictory to say the markets are now going to be more able to react to things in the economy, when if you ask why do these things change in real time, it's because you get an NFP report that surprises to the upside. You get a geopolitical shock that sparks inflation, and so I'm kind of curious, I guess, like, okay, so if you take away forward guidance and you take away these dots, do you honestly believe that the markets are going to stop trying to forward lead what the Fed's going to do because they're not explicitly telling you what they think they're planning on doing in the next 12 months? And I think as a new Fed chair, I was a bit disappointed just not having like a clear understanding of what that's going to mean. And yeah, I want to get maybe David, your opinion on what I just said. Like, is there something that I'm missing as far as, do you believe that we're going to be entering this new regime where markets are just now suddenly free to react? What was different before then, right? What's changing?
Yeah, no, these are all great points. Well, my first reaction is that you're a tough rater. Did you say C?
C is an average. Okay.
Okay,
C in my household, C was average. So you get not
Yeah, I was going to
really
say, Gabe.
bonus points, but you get kind of like in the middle of the road there.
Yeah, I was going to say, Gabe, please don't ever rate me for a work, a peer review, thing. So I'll stop at that.
Awesome. No, but I think you brought great points, Gabe. Fully agree. If this gets carried out, which seems to be the case, right? In the press conference, Kevin Warsh said that there's going to be basically a task force for everything. But one of the things that they will apparently be evaluating very deeply is the Fed's communication framework. I don't know if I read too much into it, but I had the impression that even I'm not sure if the dot plots will exist come like next year. So yeah, I would expect to see a Fed that is a lot more circumspect, not only with regards to forward guidance, but even to some of the things or some of the information that we got from this very first meeting. To me, it seems like we might be entering an epoch in which the markets will be reacting much more strongly to specific economic releases instead of central bank announcements or central bank speeches and things like that, which is honestly how the market used to operate until not that long ago. So in one sense, I understand that if I were in Kevin Warsh's position, I would love to have the market as a signal that you can use as input in order to inform your policy decision. But yeah, I fully agree that there is a tension and a circularity here, because in a way, the market will obviously continue to guess what the Federal Reserve is going to do. So let's see.
Yeah, that's fair. And I want to say, like, there's this, I think, famous quote. I heard it on the radio. So shout out to whoever was speaking on Bloomberg Radio yesterday. It's, I stop panicking when the Fed starts panicking. So think about how investors react. Investors panic, markets sell off. What's the Fed put? The Fed put is the thing that backstops liquidity and injects it when we see, risk off, when we see the turmoil. That typically happens first, right? We don't get, Fed cutting rates, and then the market reacts, right? Market reacts first. This is why I think I've heard it so many times when we're saying like the Fed's gonna, cut rates. Well, I think Mike McGlone from Bloomberg always says, well, you're gonna start. You need to see like a bear market. You see a drawdown first. You need to see stress in the financial system first before you get the Fed to react. And that's happened in COVID. That's happened historically in 2018 when we saw that autopilot tightening cycle. This is probably going to continue, is what I'm trying to say. Tomas, this is your wheelhouse. I want to give you a chance to jump in, give your take. Do you think we're in a new regime with Kevin Warsh, or is it going to be trickier than we expect?
I mean, I think you're right about the historical outcomes probably being much the same. That is, hey, like you get the remedy after the poison. And I think the big difference this past year with this regime shift is that there was so much attention around the idea that the administration had an opportunity to really try to chase this a nominee that would like fulfill its hopes and goals, which more straightforwardly, in my opinion, relate to the back end of the curve. Everything around mortgages, for example, and the longer term financing rates, which are really important because of the amount of refinancing the Treasury has to do. And I think what threw me off, and we talked about this in the past, is that Kevin Warsh doesn't want to do those things, or at least like his policy choices or his philosophy around the balance sheet would not, be the straightforward, easy relief that people were looking for. And so I agree with you that the outcome is going to be probably much the same in the past. You get a monetary easing when there's a crisis or a stress event. But the difference is that I think people were expecting Trump would take the opportunity to find someone who would take the easy path, if you will, and perhaps like preempt the crisis and just allow things to run really hot. And that I think is where there's been this big reversion in expectation.
Yeah, that's a really good point. So I think most of the commentary that I've been reading has been talking about this hawkish rates message that we got in the meeting. And you look at the yield curve on treasuries, it looks like we're seeing a flattening with the front end moving up higher, trying to price in this hike that's, I think, fully priced in maybe for your end. Tomas, you follow that a lot closer than I do. But my follow-up question, and this is to anyone that wants to jump in, is are we going to see a Kevin Warsh that's hawkish on rates or hawkish on the balance sheet? I think the quieter lever to pull is the balance sheet. We don't get to talk about that too much, but this is where I think the the new Fed chair spent some time, voicing his concern. So whoever wants to jump in, feel free to take that one.
I personally don't think he's gonna do anything near term on the balance sheet in a dramatic fashion. I mean, he's made it pretty clear directionally he thinks that the balance sheet should be much smaller, and that the Fed's gotten too much in the policy of like dealing with long end of the rate curve and not allowing the market to do its thing. But I did come away a little bit net bearish yesterday in the sense that I thought that he was going to punt on this issue for some time. And what he made clear is that he wants to actually start seeing proposals, via this task force as soon as the fall, and for them to start like really debating it and discussing it, I guess by the third or fourth quarter of this year. And so that's faster than I had expected that we might be having this debate around the balance sheet. And again, like directionally, he's made it clear that he thinks that it should be smaller. So I don't really know what proposals he's going to entertain where that changes absent a crisis. And on the interest rate side, I mean, he's really, in my opinion, the market's been pretty good at pricing the expectations here. We did definitely get some more bid into the probability of a rate hike by year end. I think last week it was like a 40-50% chance rates would hold flat by year end. Now it's 15% based on the CME Fed Watch. So we had some repricing there, but the market has been a bit ahead of the curve in terms of where they think the trajectory is going to be. So I just suspect that he's going to be focused on the interest rates. It's going to probably follow what the market's already pricing. And on the balance sheet, I'm a bit net bearish in terms of how quickly he wants to start thinking about it from a policy perspective.
David, Peter, Sui, Mark, any other takes that you want to throw in here? We'll probably have to turn the page here soon.
Yeah, no, I fully agree with Thomas. Perhaps the one thing I would say is that Kevin Warsh has, for a long time, been a critic of the Federal Reserve balance sheet expansion. And I would expect to see some of that at some point. As Thomas said, maybe this could come even earlier than expected, but probably more like towards the end of the year. But on the other hand, I think his hawkishness on interest rates, I think that attitude is a lot more context dependent and a lot less, I would say, fundamentally grounded than his stance on the balance sheet. So I think on the interest rate, we're going to see, of course, there is the kind of Alan Greenspan 90s style thesis, right, of trying to preempt some of the productivity gains that could come from AI by cutting interest rates ahead of that cycle. Maybe now is not the right time to have that discussion because of everything that's going on in the Middle East and with energy prices and all of that. But I think at some point we'll have that discussion too.
It does seem we're on that disinflationary path. I looked up today, the average price of gasoline, I think, has fallen back to a 3 handle. So that should start feeding through into the CPI and some of these barometers that the Fed looks up, such as core PCE or headline PCE. That's a great point, David. I think, if you look at what's been driving this inflation shock, what could the Fed or the prior Fed have done to mitigate that, right? So, the Fed can't control oil prices. It can't control energy shocks. And sometimes they just have to react accordingly to things that are out of their control. And I'm excited to hopefully see, this new regime, this new era with Kevin, and I hope we get back to price stability as well. I would just add one last thing before we kind of turn the page that, to get to price stability, historically, it's a binomial outcome. You either get a hard landing or a soft landing. So we want to all be cheering for a soft landing. And that looks like, a more gradual, path to the 2% target versus, a quick overcorrection where we get into recession or some sort of economic contraction territory, which is riskier, right? So Yeah, this is exciting times. Everybody should be following along because there's a lot happening. And with that, I think it's important to keep the show rolling along as we jump over to the next topic, which is, David, you just put out a new piece relatively recently on synthetic yield on Bitcoin. I think you did 37,000 back tests across a series of options venues, studying how one could feasibly garner yield from an asset like Bitcoin, which does not have any interest, of course. So David, how does one generate yield on Bitcoin with options?
Yeah, that's a great question. And just for context, the motivation around this white paper is because obviously the markets are pretty much sideways or even down. And during those times, one of the things that we see our clients gravitating towards is yield strategies, right? So that's one of the ways that I think an institutional investor can still have an edge in this market and produce excess returns. So we hear a lot about covered call selling, right? This is a strategy that has been increasingly used by a lot of folks who are sitting on relatively large stacks of especially Bitcoin, but increasingly other assets too, debts and Bitcoin miners and just traditional hedge funds and even a few like high net worth individual investors. So we hear a lot about covered call selling. But the thing is that what we tried to produce was a paper that gave a little bit of an idea of how what these yields look like historically, and how consistent they are. So of course these are much harder simulations to do compared to like those Bitcoin in a portfolio type of reports, right? Just saying, hey, if you add this amount of Bitcoin, this is what happens to a diversified portfolio. Here in the covered call selling realm, there's a lot more factors into play, right? There's different deltas one can choose, there's different tenors one can choose. More importantly, there's a wide array of risk management filters that I would say have to be in place if you want to deploy this type of strategy in an asset that is as volatile as Bitcoin. So basically what we tried to do was to kind of comprehensively test what the surface looks like. And what we found, in a way, a few things were not very surprising. So things like the deltas at which a lot of the returns tend to cluster around. So usually kind of lower deltas because Bitcoin is a highly volatile asset. A few things were more surprising, especially like with regards to tenors. Usually, historically, it has made sense to play in the 21 days or even 30-day or plus tenor range, which is very different from what we see in TradFi. But I think the main highlight of the paper is that Bitcoin covered call selling strategies can produce relatively reliable yields. I mean, we're here talking about medians of 4 to 6%, and these are yields expressed as outperformance over Bitcoin within a relatively large period of time. So I was using mostly 3-year windows. So for folks who are interested, this is definitely an active management strategy. There's definitely a lot of risk management that needs to go around it. But folks who are willing to put in the effort and who are also willing to look into it from a relatively long-term window, right? So here you're usually talking about multi-year timeframes. The returns are there and they are fairly consistent. So that, yeah, this is basically the main highlights that I found in the paper.
No, that's awesome. If you haven't had a chance to check out David's paper, it's a really, really good read. One of the things that really stood out to me was this chart that you had where it showed implied volatility empirically graphed against realized volatility, and you compared those lines to other asset classes. What did you find when you did that?
Yeah, that was one of the charts that a lot of folks liked in that report. And it was basically showing the volatility risk premium of Bitcoin versus other more traditional assets that are used in a covered call context, right? So I basically used the SPY, which is the leading S&P 500 ETF, and the QQQ, which is the leading NASDAQ ETF. And what you can see is that Bitcoin has a volatility risk premium that on average is 2 to 3 times larger than these other more traditional asset classes. And the reason I think is because as much as the options market has matured, and it's insane how much this market has been growing, right? I highlight in the paper that the open interest in Bitcoin options today is already larger than the open interest in the whole Bitcoin futures complex. So you can add all the perps, Binance, OKX, Bybit, decentralized exchanges as well, Hyperliquid. You can add dated futures, things like the CME. If you add all of that complex, the open interest in options is already bigger than the futures. And this is not entirely surprising. It's kind of what happens on the equity side, even to a larger extent. But even though this market has been growing significantly, the Bitcoin options market is still very call heavy. If you look at like the two main markets, which are IBIT options and then Deribit Bitcoin options markets, about 2/3 of the open interest sits on call options and 1/3 put options. If you look in traditional markets, it's usually the other way around. It's usually 2/3 puts and 1/3 calls. So the Bitcoin market is still a very call heavy market, which means that these call options, they tend to be a little bit more expensive, right? The skew favors call options. And this is great for folks who are selling those. So yeah, that's I think the empirical anchor for a lot of folks who are looking into these Bitcoin covered call selling strategies.
That's really interesting. I think it was Tom Lee who pointed out that the peak of MicroStrategy's premium to Bitcoin, like their MNAV premium, happened around the time, or maybe the exact day, that the U.S. approved options on these spot ETFs. I'm not sure if that's factually true. It's something that's interesting to check out. But what we have also seen when we do our analysis on implied volatility across the surface is since these options have come to market, specifically the ones like on IBIT, which has the majority, almost like 95+% of spot Bitcoin ETF options volume, it's really compressed the call side. And so I wanted to ask Peter, from where you sit, what kind of strategies are you seeing coming to market? You're someone who's very close to these issuers, that talks to them on daily. What are we seeing in the market today?
Yeah, I mean, I think that the most glaring example is a client of ours, iShares BlackRock, launched their Bitcoin Premium Income ETF. So I think that the makeup of the portfolio is IBIT plus between 25 and 35% call options. So kind of seeing, and David and I worked on this from an education standpoint at Bitwise, was, a majority of the products in the Americas, especially in the States, is, geared toward financial advisors. And as David alluded to, a lot of these covered call strategies are very common already on traditional assets, specifically equities. So we're kind of seeing an appetite for this, yield type strategy on Bitcoin. There's a lot of other stuff that we're excited about, from like a multi-asset portfolio to on-chain perspective. But we're seeing that there still is a very large education curve, especially from the financial advisor space, investment advisor space. So, there's been an appetite for this. People are very bullish still, despite, the price of Bitcoin. I feel like a lot of these quote unquote, wirehouse or independent advisors or registered investment advisors are just starting to dip their toes into Bitcoin or just digital assets as a whole. So having these types of covered call strategies, in the arsenal, or, on the shelf, to where people can buy spot, but can also kind of buy a yield generating product, there's a large appetite for it, even though the market, it's been very bearish. Entering the market with these types of products is something that institutions and, Gabe, you and I speak to advisors a lot as well. Just, that's something that they understand. So it's something that from an investment policy committee, they can get behind because they've done this in the past just with different types of vehicles and instruments.
David, is that what you're also seeing on your desk over at Anchorage?
Yeah, 100%. Definitely interest around income type of strategies. On the ETF side, I'm particularly very bullish also, as Peter said, about these multi-asset kind of vehicles. I think it was, T. Rowe Price, right, launched a new actively managed ETF. I mean, we now have the index ETFs, the crypto index ETF. So yeah, I'm very excited about these innovations too. And definitely, yeah, very similar to what we're seeing.
Are you seeing any questions on your end on the tax treatment of these covered call strategies or these income strategies? Because I know with covered calls, it's a bit of a tax disadvantage versus something like the futures basis, where you have the different tax treatment on the CFTC futures.
Yeah, it's a good point, Mark. I wonder if this depends a little bit on the type of investors, but that's definitely a thing. And I guess in that context, we didn't explore this in the paper, right? So in the paper, we did everything on a pre-tax basis. But one of the things that I hear every now and then is that folks, they tend to focus a little bit more on longer tenors in order to have to do less rolls and perhaps do incur in less trades and capital gains less frequently. But yeah, for sure, that's a very good point.
Yeah, I think Mark, like I'll chime in, and it's again, going back to our past experience, was David and I had Bitwise speaking to a lot of advisors on a daily basis, was a lot of like these products, I think generally are in some sense geared toward ultra high net worth or high net worth individuals. And usually from a tax implication standpoint, they're offsetting their taxes in other parts of the portfolio, and it's more of a long-term play. So I think that at least, speaking for a handful of folks in the space, it's a little bit less of a concern from a tax implication standpoint. They usually offset that in different areas of the portfolio. And, this kind of being able to have a buy and hold strategy for Bitcoin while still being able to kick off a percentage of a yield on it is very attractive. And kind of the tax implications are a little bit lower on the totem pole in terms of concerns.
100%. And the other thing I would highlight is that, at least to the extent that I can see, basis trades and funding rate trades, they're not at their most attractive time right now, right? So demand for leverage in crypto overall has been pretty muted. So the types of yields that you can find in non-covered call selling strategies is also probably another factor that is pushing more folks towards looking into these strategies, I guess.
Yeah, those bases on the CME have just really stayed relatively sanguine. We really haven't seen that pop that you get in any sort of these up days. That's something that if you want to have a signal of something that's a real shift in sentiment, is to corroborate or find like a cross confirmation with up days on Bitcoin and basis expansion. That's a good signal where you could tell that sentiment's really shifting. And so that's something that you can follow along when you go to our website, cfbenchmarks.com. We've got our basis rate indices for Bitcoin and all the other CME pairs that we reference on the CME. And we also do have our Bitcoin Volatility Index, which has a 3D volatility surface, so you can see where options are being priced, whether rich, whether cheap, on the surface as well. Tomas, I wanted to bring you in because I've seen you having some really nice hot takes on the stretch situation. Stretches, of course, is another Bitcoin product that kicks out a nice dividend. If you could give the audience maybe a quick rundown on what we're seeing today. Actually, we're seeing it trade, I think, in the 80s now, right?
Yeah, it's definitely a stress test today. Stretch is one of MicroStrategy's preferred equity securities. It's the most popular one that they really went behind. They IPO'd it last July. I think it was a 1 billion, maybe just north of that offering that they upsized, and then since then they've been adding quite a bit via ATM. So it's about 10 billion of liquidation preference that's been issued. That's outstanding, but it's now trading at 83 cents to par, or $83 versus $100 par. And this is the one that they have communicated in the past, trying to target a price band of $99 to $101 via a variable dividend rate. But the thing that's interesting that I wrote about recently is that if you look at the quote unquote like credit spread for the dividend yield implied by Stretch over and above the maturity or duration matched treasury yield, which has been rising over the last several months, it's very, very highly correlated with Bitcoin price. And the notable thing about Stretch is that they haven't raised the dividend since March. And so you have this a collision of two forces happening. One, you have interest rate trajectory rising, where you've seen that in the yields of sovereign debt around the world. You have the trajectory of monetary policy looking tighter than it was months ago. And on top of that, Bitcoin price has traded materially lower. And so all those things are working against them. And because they haven't adjusted the dividend rate, the price will do it for you.
It seems to be that mechanism that you're talking about, that relationship with Bitcoin price, is something that is really starting to bear out as we see, I think, price not see a sustainable rally higher, and Bitcoin trading around, I think, 63,000 today. David, I wanted to ask you, are you keeping an eye on the Stretch price as well?
Yeah, I definitely am. I think, like many folks are, Thomas's point is awesome. The one thing I'm curious about though is SATA is trading at par, and I think
That's a good point.
if we look at current levels, I think SATA pays what, a 13.5% yield. MicroStrategy stretch now, or strategy stretch now, I think it's probably implying something around 13% or so. So yeah, I'm just curious because definitely SATA has advantages over Stretch in that it pays dividends daily, so it doesn't have the issue of too much time going between one X date and another, right? So folks are trading in and out here. That on the Stretch side, that's not very possible with SATA. But on the other hand, it does seem to me that strategy has bigger coverage versus Strive. So yeah, I'm just curious. I don't know if the group here has any views. Maybe this is just technical, just investors leaving Stretch and Mass. But yeah, I'm just curious if anyone has a view on that spread, which I think is interesting.
You think it's too tight, if I'm reading correctly, right?
It seems to me, yeah.
Yeah, I agree with you actually quite a bit on that. My guess, honestly, is that um, they they being MicroStrategy saw way more success and demand for Stretch than they were anticipating around that kind of April, May timeframe, which is, I believe they issued probably over $5 billion in that time frame. So about half of the notional that exists right now was issued in the last couple months. So there's a lot of fresh investors, fresh capital that went into this product. And I think it probably outpaced their own expectations, would be my guess. And I think what's interesting is that you have a confluence of people who were buying into it and kind of disguising the underlying signal around, hey, interest rate trajectory is going higher, but the coupon rate's not changing. But there's just so much demand that people overlook that. And then on top of that, you did have, to my knowledge, a decent number of people who were trying to do this kind of like dividend arbitrage. They might have been doing it on a levered basis, seeing all the demand coming in from retail investors and whatnot. And I think a lot of that just like flushing out. and reversing. Similar to how you had a lot of ETF buying in late March into April, into early May, and then that reversed and flushed the price. So it's kind of seeing that same dynamic play out. No, correct.
Tomas, do you know how much capital they have raised through that period? It's okay if you don't. It's a very pointed question. And also, do you know how much capital that they raised was spent on Bitcoin already, or do they have dry powder left over?
The vast majority of the capital that they raise in general is used to buy Bitcoin. And any excess capital that they've raised over the last year have been used to initially fund the $2+ billion USD reserve, or to pay the dividends, which can range from like, call it 100 million to a couple 100 million on a month-to-month basis, depending on whether the quarterly dividends are due for some of the preferreds. So like most of the capital went towards either dividends or this USD reserve that was raised in excess of Bitcoin purchases. The issue that they had more acutely a month ago is that they decided to do a long-term move of retiring $1.5 billion of their convertible debt through a cash payment, which I actually thought was a really good idea if you're thinking long-term. Where I think they made the misstep, and which surprised me, is that the week that they retired the debt, I had expected that they were going to hit their common equity ATM pretty hard to refill their USD reserve. And so because they didn't do that, it just creates this kind of like negative feedback loop of people looking at this smaller USD reserve against a bigger dividend burden. And it's just one of those nasty feedback loops that's really hard to dispel unless you take like decisive action. And they've decided they wanted to slow roll it by just raising $100 million of excess capital on a weekly basis, it seems. So we'll have to see how it plays out, but it's really one of those things where the way I describe it, the fundamentals don't really matter. It's like a price sets the narrative conversation. Because if you think about it, if Bitcoin were $100,000 tomorrow, no one would be talking about this issue. And so it's a very mechanical, nothing to do with like Bitcoin as a network or sound money or anything like that. It's purely like mechanics around liquidity.
Yeah, and their USD reserve has remained a pretty steady size. I think it's sitting around 1.1 billion. So they've done a good job of managing it and kind of holding it around the same size. So that really shouldn't affect anything. They haven't been drawing it down anymore.
That's right. I think people just want to see that they're taking like decisive, quick action, and they've just not done that. So in two ways they've kind of been defying the market and the patience of the market. One being on the dividend rate side, again, like just holding the rate flat for 4 months. I think there was some capitulation early this week on Monday because they announced their first semi-monthly dividend in July was going to be the same rate. So they basically telegraphed that for the next month, they're not going to do much on the coupon rate. And then on top of that, yeah, again, like when people were calling for a bigger cash raise, they've just been slow rolling it. So in a lot of ways, I think the market's testing them.
Thank you. Thank you all. I think we've got a few more minutes left to do our final fast round. So David and Peter, what we do here is we just try to quickly share with the audience what are the key things that we want to keep on our radar for like the next 7 days, like the week ahead, basically. And so and we also just want to say, Ish from Bitwise, Ish has just joined. So Ish, it's good to also have you here and share your thoughts on what you're looking out for. David, since you're the guest of honor, why don't you do you want to go first and give us your week ahead?
Oh yeah, thank you for the guest of honor classification. I don't deserve that. But
No, come on.
yeah, I mean, over the next 7 days, I mean, this is now an interesting part of the market because we're kind of entering the high summer. It's usually when we start to see activity cooling down a little bit, volumes as well dwindling. We haven't seen that though. I mean, June has been a relatively busy month in terms of especially Bitcoin spot trading activity. We're probably 30% above 30% above April, 50% above May. So I'm interested in seeing how these kind of activity levels remain, usually this period where things are cooling down. The one thing that I'm paying attention to very closely, not sure if in the next 7 days, but definitely in the next couple of weeks or so, is how discussions around the Clarity Act evolve, because I think we're getting into that narrow window that we would like to see some sort of activity so that it would get to a Senate floor voting, maybe at the end of June, maybe beginning of July, so we can get to the whole process of getting it to the president's desk before the Congress recess, which is at the beginning of August. So I'm not sure if that's a 7-day topic, but definitely something that I believe will start gaining more traction as this window starts getting tighter. It's obviously a very important theme for the industry. The market structure bill, I would argue, is as important, if not even more important, than the Genius Act, which was approved mid last year. So I'm very much looking forward to see that and hopeful that it will get pushed.
Thank you, David. That's really good. Mark, you are next up on the picture sequence. So give us your quick take.
All right, yeah. So May PCE, that's going to be pretty big next week. We'll be watching that. And then we have the jobs report next week that is good to look at. Yeah, and just on the regulatory front too, something I'll be keeping a close eye on is this lawsuit that's going on between the CME and the CFTC around the around perps being available in the U.S. now. So that's just something to watch.
Thank you. Tomas, I think you're left or right in the next in the sequence. So
Yeah, I mean, aside the data points that Mark brought up here, I also am keen to see if there's any kind of news or commotion around the Clarity Act stuff. It's hard to communicate this when things are so volatile, but when you have like the Fed backdrop feeling tighter, like the fundamentals become even more important, in my opinion, in this kind of environment. Because you just don't have that kind of like cushioning effect of like an easy money trajectory. This applies for both equities and crypto. And so I think the relevance of the Clarity Act is becoming even stronger. And I agree with the timeline that David's proposing here, that you really want to start seeing process or procedural steps moving forward over the next 1 to 2 weeks, lend more confidence that we're going to get this passed in the next month and a half.
thank you. Peter, you're up.
Yeah, I mean, I agree with both Tomas and David. Yeah, like definitely on the Clarity Act is very important. Obviously, the Iran and U.S. tensions, I think, are very important. That's had a pretty big impact on crypto as a whole. And I think, too, I think Citi made a comment on it that, keeping an eye on the ETF flows into Bitcoin is something that's been, very important, kind of, keeping an eye on that, as well as the altcoin ETFs as well, kind of seeing how those play out, and just, keeping a daily watch on those.
Ish, you are our fresh honorary guest of now on the show. So I want to give you the mic here.
Awesome. Thanks for having me on, Gabe. Yeah, this week, I think, as you guys were talking about, stretch is one thing I'm going to be keeping an eye on. I think it's very important signal for the market, especially given how much of the rally this year that it drove. So it should be interesting to see if it can recover or how much lower we may be going. And then looking at more of the crypto tokens, I think some of the kind of idiosyncratic areas that have been getting some traction that I'm going to be keeping an eye on are DeFi. There's been a lot of institutional traction there. This week we saw like Standard Chartered and Grayscale put out pretty bullish price targets for Aave, Uniswap, and also the perpetual futures names. Obviously, Hyperliquid is the only survivor in this market, but some others like Aster and Lighter have had recent pops.
Perfect. Thanks for joining on such short notice. I'll wrap things up. So things that I'm looking for in the next few days, the next 7 days. Tomas, you had a really good chart showing the moving average, I think, of ETF ETF flows, and we've had some positive days, I believe, in IBIT, for example. Now that we've seen how that rate cut trade is pretty much flipped now to a rate hike trade, and we're in kind of like a little bit more of a hawkish regime, I want to see ETF flows kind of sustain over the next few days. I want to see, more creations, more inflows on the net basis, and so I'll be watching IBITs and all the other ETFs as well, seeing what they can gather. Another thing that I'll be watching very closely is the Strait of Hormuz reopening. We just had the deal between the U.S. and Iran signed electronically, and that is set to open the strait for the next 60 days. And so far, on the live trackers, I think we've only seen a few ships pass. So while oil prices and gas prices have fallen tremendously since the news broke on Sunday that this deal was coming, we're still seeing, I think, a lot of supply disruptions. So you want to see more ships come through. I think I was reading this morning that a JP Morgan or Goldman estimates that it will still be at 70% capacity even when the strait completely reopens. So it's going to be interesting to see how oil ultimately gets fully priced for the new reality of what this strait looks like. And I think that's going to ultimately impact the inflation picture here. So we should be following that closely, and I'm sure Fed officials will also be tuning in for that as well. With that, I think that's the hour. So I want to thank everyone for joining. And as always, do your own research, trade safe, and we'll see you next week. Thank you.